There is only a very few things you need to do right to become a successful trader. In this video, I'm going to show you how I found the 3 keys to profitable trading and how you can too. Do you ever feel like no matter how much you trade, you're always one step behind? You win a few trades, then you lose it all, or get overwhelmed by all the noise in the market? I've been there and I know how frustrating it can feel, but I have found 3 simple keys that can turn it all around. And today I'm sharing them with you. But before we get to those keys, make sure you stay to the end of this video. I'm going to be breaking down a trade where I applied these keys I'm going to teach you today. This was another winning trade from yesterday. I'm going to show you exactly my entries, my exits, my thoughts behind it, so you can take these principles and apply it into your trading immediately. Key number 1 is directional bias. This is your key to simplifying the market. The most important part about trading is understanding the directional bias. What is the movement of the market? What direction is the market moving in? Is the market trending? Is the market ranging? By understanding the movement and direction of the market will help you determine whether you're looking for long trades or whether you're looking for short trades. I'm going to show you 3 different ways on how to determine the bias of the market. The first method we can use to analyze the bias of the market is through price action. I have the Solana chart over here, and all I've done is I've marked higher highs or higher lows, lower highs or lower lows. And all you can do is you can mark it on the chart. You can go into a higher time frame and do this, either on a 4-hour, 8-hour, 12-hour, or daily. Based on this, you can determine the movement of the market. If you're getting lower highs consecutively, that can determine a downtrend. And if you've got higher lows consecutively, that can determine an uptrend. So all you do is on the higher time frame, you mark out on your chart, just like I've done here. It shows you the bias of the market quite nicely. For instance, over here, we've got a lower low, and then we get a higher low. At this point, this is showing strength in the market. This is showing that we're on an uptrend. If you get another higher low, you can see we are on a strong direction up over here, until we start getting a succession of lower highs that allows it to change the market structure. You'll also notice over here, when we get a lower low, then afterwards we get our first higher low. At the higher low, we can look for breaks in structures. You can see over here, we've got this ranging aspect happening. And then at this point over here, we get a break above this level. So what was previously a resistance point, price breaks above it. And then you can see we get huge momentum candles here. Breaks above this resistance point and it shows strength in the market. And then price comes back down, forms another high, a low over here. And you can see this would be a place we would look for an entry because it's showing strength in the market and it's clearly showing that we are in an uptrend. If we get a succession of higher lows, it means we're in an uptrend. If we get a succession of lower lows, it means we're in a downtrend. This is a very simple way to mark up your chart, understand the bias of the market just through pure price action. Another method of determining the bias of the market, which is one of my favorites, is using our indicator called Trend X. Trend X is a trend-based indicator. It helps you quickly and easily discover whether an asset is going into a trending phase, a ranging phase, bullish or bearish. So you can see in this example over here, we get our pivot grid, which are these 3 red lines, and this represents 1 month's worth of data because we're on the monthly Trend X. So when price breaks above the monthly Trend X, right over here, this is the exact location that we can start looking for our long entries because it's signifying to us price is going to a certain level where there's more demand in the market. If we go into the next month, you can see we get the same scenario. As soon as price breaks above the monthly Trend X, we can start looking for long entries. And both of these locations turned into very successful trades. If we go 2 months back, you'll see over here, price is underneath the monthly Trend X. And these are precisely the locations where you would look to take shorts, because if price is underneath the monthly Trend X, it's a short market. If it's above the monthly Trend X, it's a long market. So simply by using this tool and understanding the Trend X, which is basically this line in the sand that determines whether an asset is bullish or bearish, and you can trade accordingly just by determining that. And then our third method for determining the bias of the market is by using our indicator known as imbalance X. Imbalance X is a fair value gap trend line indicator, and it helps show you when price is going into either a bullish phase or a bearish phase. How it works is it determines fair value gaps. It draws a green dot if it's a bullish fair value gap and a red dot if it's a bearish fair value gap. So you can see in this example, as we got this green dot over here, this is where we start looking for our longs. And as long as it stays green, we're only looking for longs until we get a red dot, and then we start looking for our shorts. This can give us clues as to whether the market is more of a bullish environment or a bearish environment based on this bullish bearish momentum. So you can see over here we got a green dot. This could have been a long entry. This could have been a long entry. This could have been a long entry over here. But then price only really took off when we got this fourth green dot, and then it suddenly took off. So the key to understanding with the market is the market moves like this. It moves from ranging into trending, from ranging into trending, ranging into trending. But it ranges around about 70% of the time, and it trends around about 30% of the time. So sometimes you can get caught in this ranging part. And we have another tool that can help you with your entries when we get into this ranging part. The first step is understanding the bias and direction of the market, but we also must understand the best places to take our entries in these kind of market sentiments. Another tool we can use to understand the bias of the market is Scanner X. Scanner X is one of our price action scanners at Easy Algo, and we use it to determine the sentiment of the market. It's based on using our Trend X concepts. So for instance, if we come onto the filter section over here, you can see we've got monthly, weekly, and daily Trend X's over here. Depending on what trading style you like, let's just say we're looking for weekly Trend X's that are above the pivots. Right now in the current market conditions, we only have 6 tokens that are above the weekly pivot, and these are the tokens we're most likely to look for long positions. So you can see it's above the weekly pivot, and it's basically touching the weekly pivot now. So this could be a place where we could start looking for a long trade. Our Scanner X system is based purely on price action, and it's helping us determine where price is located in relation to these key levels. Once you understand the relationship of price in the key level, like you can see over here, every time price gets on top of this Trend X, it explodes, gets on top of the Trend X, and it just takes off, gets top of the Trend X. You can see, look, we get these very volatile movements on top of the Trend X. Guys, this key level indicator shows you precise locations where you can start going bullish on certain assets. On the other hand, if you're looking for sells in the market, we look for all the assets that are below the Trend X. And you can see right now, majority of the market is actually bearish. So if we click over here, you can see as it breaks below the Trend X, we get this massive drop. So this is a very simple way to determine the bias of the market. Key number 2, perfect entries and exits, which means no more guessing on the charts. Having a very good entry plan and entry strategy is critical for your success, especially when it's based on confirmations that has a low risk, high reward principle. I'm going to share with you some examples on how you can determine the best entries for your trades. Let's dive right in there. One of the ways we can use to find amazing entries is by using Fibonacci. If you open your chart over here and you click on this tool set in the corner, you'll see it says Fib Retracement. Is a tool we can use to find very good entries. You can see we've got a swing low over here and we've got a swing high. So take your Fibonacci, mark out the low and the high, and these are the inputs you want to put. My main focus is a 65 to 88%. And for me, this is the golden ratio zone. Well, this is an important level for looking for entries. When price comes into the 65 to 88 region, this is one of the best places you can look to take an entry. If we measure the complete swing now from the low, this is the lowest to the highest points. You can see it happens again right over here. Price taps into the 88% region, and that would have been a fantastic entry. If we keep going, it taps into the golden pocket region over there. That would have been another entry. If we apply it again from the swing low to the swing high, price comes, taps into the golden pocket, 79%, that becomes another perfect entry. So by using Fibonacci, we can measure swing sizes, and we're looking for price to retrace between 65 and 88% of the swing. This is a discount zone where we can get the asset at a very cheap price and has a high likelihood of reversing at that point. In order to discover the best places to enter on your chart, it's important to know what the master pattern cycle is. The master pattern is one of the most most important patterns that exist in the financial markets. And once you learn this, you'll begin to see this on the charts everywhere. But this is critical in understanding the best places to get your entries. If you look at the chart over here, we've got a 3-phase cycle. Phase 1, contraction. Phase 2, expansion, and phase 3 is the trend phase. So price is always going through these 3-phase cycles, and it's happening on every different time frame and every asset class. No matter whether it's stocks, crypto, indices, it's happening. So what we do is we pay attention for phase 1. This is when we get a simultaneous lower high and higher low. A box draws around it. We can draw a box. Then price expands out of the box into phase 2, the expansion phase. This is the whipsaw phase. This is the phase where most retailers get tricked and liquidated. It is the manipulation phase. Once price is whipsawed around this value line multiple times, taking out the buyers, taking out the sellers, extracting liquidity to fill the market makers' massive orders, then when they are ready, they take the price higher and they go into the trend phase, which is the profit-taking phase. So once you understand this 3-phase cycle, you will be able to discover the best places to look for your entries. The best long entries are always going to be underneath the value line, and the best short entries are always going to be when price is above the value line. So the value line keeps you in alignment with the best places to look to enter longs and where to look to enter shorts. But this is all dependent on the bias of the market. If the market is in an uptrend, you're only looking for longs when price is under the value lines. If the market is in a downtrend, you're only looking for shorts when price is above the value line. So it has this counter trend entry strategy. The most important thing is to understand how to identify the contraction phase. Now that you understand this pattern, let me show you on the charts. Here we are at the Bitcoin chart. And what I've done is I've turned on our software. We have an indicator called Indicator X, which marks out these levels on your chart automatically so you don't have to. But you don't need to use our software. If you want to do it manually, all you need to do is look on the chart where you see a simultaneous lower high and higher low happening, and then draw a box around it. So you can see this high is lower than that high. This low is higher than that low. When we get this squeeze happening, the simultaneous lower high and higher low, this is what we call the contraction phase. And then all you do is you draw a line out the center of the box when price starts expanding out the top of the box and the bottom of the box, going into this whipsaw phase. So it's very easy to do it manually. You don't need to use our software, our indicators. I'm just showing you the different method if you want to work it out on your own. So now if we come back to the chart, we can see on the Bitcoin chart, I'm on the 12-hour over here. Every time price was underneath the value lines, this was going to be our best places to look for our long entries. Can you see that, guys? It is crazy how accurate this is. So this would have been your ideal long entry, long entry, long entry. And if you had caught long entries at those positions, you would have been in massive profits, 20%, 26%, 25%. This is just showing you how by using contraction boxes and value lines, you can get the absolute best entry. Then we also use the TDIX. It's another indicator of ours. It is a volatility oscillator, and we use it with getting perfect entries. What we're looking for every time we see these green dots, you can see this white RSI, it breaks out the bottom of the Bollinger Band. This is what we call shark fins. These shark fins show us when prices has a high possibility of reversing. When we use it in combination with our value lines. So you'll see over here, there you go. We got a perfect shark fin. Can you see shark fin over there? This would have been a perfect entry. Shark fin over here, perfect entry, and shark fin over here, perfect entry. So we use the TDIX to confirm our entries with Indicator X. By combining these two indicators together, it gives you a solid strategy in finding the best entries with the most confidence. Then we have key number 3, which is our liquidity zones. This is where you can know potential areas where the market is going to move from. The market moves from liquidity to liquidity. Understanding where these liquidity pools are located is going to give you a massive upper hand in terms of where you're going to look for entries and where price has a high possibility of reacting, because this is where traders engage in their positions and they have pending orders resting. To easily identify liquidity pools, we use our custom indicator, Indicator X, that I was just showing you. It also has a liquidity feature inside of it. If you open up the settings and you scroll to the bottom, you get liquidity levels. And we have a setting that can help you find the smaller liquidity lines or just the bigger liquidity lines, depending if you're a scalper or a swing trader. The important things to know about liquidity lines is these are the areas where other traders place their stop losses. And if you can be aware where other traders' stop losses are located, these are what we call liquidity pool areas, because majority of traders place their stop losses in the exact same places. How this indicator works, it has a methodology behind it called the master pattern concepts, which is based on understanding how the market makers trade. And this indicator is completely based on market maker trading. So if you know anything about the market makers, they're always trading against the retailers or the dumb money. So the smart money is always doing the opposite of the dumb money. When the smart money buys, dumb money sells. When smart money sells, dumb money buys. They're always doing the opposite. So wherever we've got these liquidity lines or stop loss levels, these are precise locations where the market makers are looking to get into the market. If we look at the Bitcoin chart, you can see every time Bitcoin came down, it took out a liquidity level. Came down, took out a liquidity level. And now look at all this liquidity that's resting in this region over here. So around the 72 to 73 region, there's a ton of liquidity, and more than likely, Bitcoin's going to take out this liquidity before it carries on further, or it'll hit that liquidity and then it will reverse. But liquidity zones are really important. They're actually one of the most fantastic places to look for entries. Let me now show you my trade that I took yesterday. I want to break down for you exactly where I entered, where I exited, and how I got this successful trade. Here we are on the charts, guys. And this is GOAT USDT. This is a new crypto token that I was trading. And usually new coins are extremely volatile, guys. So whenever you trade these, you have to have maximum risk management employed. This was the precise place where I entered the trade, and this is the exact place that I exited the trade. I'm going to show you exactly how I was able to do this. For this trade, I used Imbalance X to identify the bias of the market. Remember, key number one is understanding the bias of the market. I used the 1 hour chart to determine my bias, which if you open Imbalance X, set to 1 hour, and I used the 30-second chart for my entry. For my entry, I used Indicator X, and I used the value lines to find this entry. If I zoom out of the chart a little bit, and I recommend always doing this, always taking all the indicators off and just looking at the plain chart and then marking out important zones. So as you can see over here, this was an important zone because look here, price touched this level 1, 2, 3, 4, 5 times. Every time price hit this level, it resisted. And then over here, it broke this level. So this was clearly the point where a flip was happening. It was flipping from resistance to support. And when price came back down to this level over here, this could be an area to realize that support could be found because this is a key level. Once we marked out that key level, then we can zoom in onto a lower time frame. This was the precise location where I got interested. Price came back down to this zone, and then I was waiting for a market structure shift. So I was waiting for a break in structures. So you can see when we get break of structures occurring, or even multiple breaks of structures occurring, this is letting us know that there's a market structure shift taking place. And more than likely, price is shifting because you can see it was going down over here. It was going down. It tapped into our zone. Then all I waited for was break-in structures to occur. Whenever break-in structures occur, it leaves behind supply or demand zones. So I marked out this demand zone over here. This blue zone I marked out here, this is the demand zone, and this is precisely one of the locations I was looking to take my entry. If you pull a Fibonacci as well, you can also see price is tapping into the golden zone. So just applying all the key principles I was teaching in this video. If we turn on Imbalance X now, you can see it's all green and it's showing that we are in a bullish trend on the 1 hour time frame. So this is confirming to us we're only looking for longs. Then I turn on Indicator X and I'm paying attention to these red value lines. This red value line is giving me very important data because it's telling me when price is underneath it, that's when I want to look to take a long entry. And then lastly, I open up the TDIX because the TDIX is going to give me more precision with my entry. And if you look over here, look at all the confluences. Price taps into the demand zone. It's underneath the value line, so I'm only looking for longs. And we also get a shark fin on the TDIX. As you can see, as this shark fin taps in here, this is precisely the place where you look to take an entry. I must admit, I did enter a little bit early because there were so many other confluences lining up. I knew that this demand zone was a prime location for price to retrace, and I also knew it was the golden pocket region using my Fibonacci. And it was underneath the value line, and Imbalance X was showing us that the bias was bullish and showing you how you can apply these principles to get successful results. If you're tired of second guessing your trades and you want tools to do the hard work for you, then make sure to click the link below, go to our website and check out what we have to offer. Inside our Discord group, we have crazy results, guys. Here's an example of Brett in the group from 2 days ago, and he says 3 trades today for me. Thanks for easy algo indicators. And you can see he's made quite a nice profit using our strategy and using our indicators. And guys, we have hundreds of these testimonials and results. Trading doesn't have to be overwhelming. With the right system, you can trade confidently, avoid emotional mistakes, and finally see the profits you've been aiming for. Click the link below to start your winning trading journey today.